Well, let's recap round 2. And how'd that go over? Well, we'll see here. I'm trying to get my telephone shut off so it doesn't ring in the middle. That always creates a little bit of a distraction. So anyhow, here we go. So what happened? Again, I start right at the top and go down, and some interesting things right off the bat. First, we see our computer team running away with overall sales. Okay. I'm going to say a general comment right now that we'll see as we go along, but generally speaking, the thing that gets missed most by student teams, especially in these early rounds, is paying attention to the customer buying criteria and trying to maximize that. Teams spend a lot of time, maybe money, which we'll see on things like sales, marketing. Okay, they spend time on pricing and those types of things, all of which are very important, and some of those actually fit into the customer buying criteria, but they fail to really look at it in each individual segment and strive for, if not perfection, strive for a best possible position there. And that really seems to hurt early on. Generally speaking, they kind of figure that out a little bit later, and it definitely improves. So part of that also depends on your strategy. Okay, different strategies might have a different focus when it comes to that customer buying criteria. But $207 million for Chester in sales. Next closest, Digby, $124 million. Why did Digby have so much in sales? Lost a little bit of money, but again, you can gather a lot of information just from here. They spent a lot of money on SG&A. Look at that, almost 30%. That's huge. Okay, might be trying to drive market share, might be trying to drive a lot of things, but that is a huge amount of money spent on SG&A. So it's SG&A to sales, so 30% roughly of their sales. So what the heck is that? It's not quite 30%, but $36 million overall. It's a big money, and we'll see that when we get down and look at the income statement. Okay. Contrast that to Chester, though, that had 8.6%, and this kind of, which is still, don't get me wrong, 8.5% of that's what, 17 million, 18 million, still a lot of money, but it pales in comparison to the 36 million roughly that Digby spent, and yet Chester generated far more sales. Okay, it could be Digby didn't produce enough. I'm not sure. We'll have to see if they had a lot of disparity or disagreement between their actual and potential sales. That's possible. Okay, but it's probably some other things too. Digby may have spent a lot of money here trying to drive sales, but maybe they didn't spend or put enough attention on that customer buying criteria. Baldwin will take a glance at that, and of course they lost some money, which is nasty, and had a big emergency loan. We'll see. The reason for that's a little bit odd. I'm thinking it might have been a fat finger thing, but we'll see as we go down and hear from them maybe. Sales of about $120 million, which is not bad really compared to the other student teams. Look at this, so a contribution margin of only 17.6%. Everybody else is, pushing 30, although Erie's is quite low as well. But SG&A to sales of 19.4%. Okay. Again, I like to look at this. I like to think about it before I even scroll down, because this tells me something. This is the amount of money or the percentage after sales that can be applied to what I would normally call operating expenses, but in this game, operating expenses are kind of the equivalent of SG&A. Okay, so if I had 17.6% to apply to those expenses, and those expenses are 19.4% of sales, these are both a percent of sales, I lost money. Okay, I can tell that I lost nearly 2% for every sale that I made. And that doesn't count some other things like interest and depreciation. Again, we'll see that when we take a look at the income statement down below. Okay, so there's a ton of information on here, and I like to kind of gather that information and get it set in my head for each team. And please don't just do this for your own team. You'll not be as successful. But if you're team Andrews and you're kind of looking at it and saying, man, look what Team Digby did in terms of this, okay? Another good example, they generated 124 million in sales on only 16%. Andrews generated almost 119 million, okay? But you got to look and say, what's the competition doing, okay? And is that important? And will it be important as the rounds go on? Obviously we'll see, but those are decisions that you have to make. Andrew's the only team that has yet to sell any stock, and I don't know, I kind of talked about that a little bit in the first round, but I'm going to give you again a little bit of general advice, and I'm not going to say that selling stock's a bad thing, okay? Selling stock for a purpose can be a good thing, especially I would say in the early rounds, okay? In the later rounds, that often switches, okay? Cash becomes more available, and oftentimes buying back stock becomes a better option, okay? What happens when you sell stock? Let me run through two things that happen. One, you dilute your shareholder base. You end up having more shares outstanding, okay? That absolutely decreases your earnings per share. I don't know if you've noticed on my scorecard, but I'll show you, okay? The number one item for scoring is earnings per share, okay? And I want that number to be high, and when you're selling stock, you're making that number lower, okay? The number two thing on the score sheet is ROE. So what happens when you sell stock? When you sell stock, you're raising cash, that's fine, but that cash is equity, okay? Return on, or ROE is return on equity. Return on anything means net income divided by that anything, okay? When you increase your equity, which you do when you sell stock, then that's the denominator. I got to think about that. That's the denominator. Okay, when the denominator gets bigger, the resulting ratio gets smaller. So when you sell stock, you're both decreasing your earnings per share and you're decreasing your ROE. Those are the two biggest things I score on, and in both cases you want those to be higher. Again, that doesn't mean it's a bad tactic, but it needs to be very, very, very purposeful, that tactic. Okay, what do I mean by that? Just in general, if you were to sell stock because you were investing greatly in things that were going to have long-term or create long-term return for your company, it might be worthwhile. What those things are, read through your guide and it will give you some ideas perhaps. So we scroll down, other than, we see the earnings per share clearly won by our computer team this particular round. The bond market summary, we'll spend some time with that maybe later, talking about it. It's kind of worth looking at a little bit. You see Erie borrowed a lot of money here in the long term. Other teams, looks like some teams have paid some back. We've had little differences here and there. Okay, but not a lot going on there. The ratings I don't get terribly wrapped up in. I will say this, anything below BBB is considered a junk bond in the real world. And so actually everything in our world here would be considered junk bond. So we come down, we look at our cash flow, and of course profits and losses that we saw up above. In Chester, our computer team had a pretty good profit. Other than that, the only two student-run teams were Andrews and Ferris that had profits, and they were a little bit smaller than Team Chester. Depreciation, and Erie had invested a lot of money, so we'd expect their depreciation to be higher. Ferris has come up. Andrews is fairly high. Chester, bringing up the back end there in terms of depreciation is Baldwin. Not necessarily a bad thing, and I'll show you maybe when we talk about capacity, I'll show you what I mean by that. Maybe having a lot of depreciation right now isn't necessarily the best thing. Accounts payable, I just kind of glance at these. These are generally a reflection of sales. Okay? Generally a reflection of sales. If your sales are going up, you're producing more, your accounts payable is probably going to go up. If you're this one I look at inventory. I'm sorry. If you're not selling your inventory, then it does create a cash drain. So Digby had a decent amount of inventory on hand. Erie sold off a lot of inventory and raised cash as a result. Okay. Accounts receivable, kind of like accounts payable. It's really dependent on what's going on with your sales. Plant improvements, huge. Okay, we see Ferris invest a ton. Erie had invested a bunch in the first round, okay, and continued pretty big investment. And Chester kind of got involved there as well, investing quite a bit. Here's where I thought maybe this was a fat finger thing. Not accusing the team on Baldwin of having fat fingers. Sorry if that's, but it would be unusual to pay out dividends at any point in this game of $91 million, nearly $92 million. Ferris's payment of a almost $15 million dividend is, I would call, extreme at this point. Okay, and I'll give you some ideas here as to why. Just jump right into that here. So they sold stock to raise cash. That may be okay, but then in a sense they used some of that cash to pay a dividend to their shareholders. That's just not, you're diluting your shareholder base and then sending them cash in the form of dividends because you sold more stock. In the real world, that's just not something that you would do. Okay? If you're going to pay a dividend, you usually pay a dividend because you have excess cash. You usually buy back stock also if you have excess cash. You don't sell stock if you have excess cash. You don't pay a dividend if you don't have cash, generally speaking. You don't. Some companies borrow money to pay a dividend. Okay, again, equity is always cheaper than debt, but to sell stock to pay a dividend, not something that I would recommend. The other thing, and pick on Ferris here, sorry, but the other thing that a little bit odd here, they both sold stock and bought some back. Okay, they just paid for two transactions that netted $6.5 million. They could have just sold $6.5 million worth of stock and saved one of those transaction costs, okay, and had the same net effect. So this was a bad move in terms of cost, or significant cost in selling and buying back stock, although a lot more in selling stock, at least in the real world. Okay, but they paid for two separate transactions there that netted out just $6.5 million, which they could have done in one transaction far more easily. Okay. Some long-term debt. So we see some long-term debt that was issued. We see some current debt. In this case, remember Erie had a big emergency loan last round, and so that got paid back. Chester paid back retired some short-term debt. They probably borrowed some short-term debt and borrowed some again this time, as did Team Erie. Nothing wrong with using short-term debt. Short-term debt's there to cover short-term expenses, and so if you're, for example, when you're finished making your decisions and you go back and you look at the finance page, it's kind of always the last one I like to look at, and it shows that I've only got, maybe a few $1 million in margin, and I don't feel comfortable with that. Why not borrow on a short-term basis, $5 or $10 million to give yourself some cushion there in case your projections don't turn out. That's one of the biggest what-ifs that I like to use when I'm doing this is just kind of saying, what if my projections don't meet what I'm hoping for? What might that cause? Well, one of the biggest things is it might cause me to not have enough cash. Okay, and nothing wrong with borrowing a little bit short-term money. Yeah, you're going to incur some interest expense, but that's way cheaper than selling stock. It's way cheaper than other forms of raising money. It's cheaper than long-term debt by far. Okay, and you pay it back the next year. Okay, you pay a little interest. Remember, interest expense is deductible, so it's a good way to take care of things. And you don't want to do the emergency loan because that has all kinds of added expenses to it. I think if you read through the manual, you'll find that it's about a 7.5% fee for that. So we got cash, and you see Chester, Digby. Here again, Ferris. Okay, they're sitting on $24 million in cash. That's a lot of cash. Good for them, and it's a decent amount of cash. It's not a ton, but they raised $7.5 million by selling stock. Okay, they didn't borrow any short term or anything like that. Okay, so they went through a lot of expense to raise $7.5 million, actually $6.5 net, that they didn't need. And I'm picking on Ferris. I apologize for that, but I'm trying to make some points there. Okay, I could definitely say the same thing about Chester. Chester even more idiotic because they raised 2.8, 2.9, almost 3 million, and they're sitting on 32.7. This is a computer team. Okay, it's kind of programmed in some of the things they're going to do, so they've just done it, and that's the way it is. Okay, so they incurred a fairly hefty expense. They lowered their earnings per share. They lowered their ROE, and to have another $3 million that it certainly did not need. Okay, those are the types of things in finance that we in particular really want to take a look at. Okay, accounts receivable, product of sales. Chester had the highest sales. We'd expect to have the highest accounts receivable. There can be some changes there if you guys change those policies. Inventory is always interesting to look at. So, Andrews, that's pretty good, right? Chester, that's not too bad. You'd say Baldwin and Digby are sitting on a little too much. Erie, that could be good. Erie might have also missed out on, some sales. Okay, and that's a real generalization because, and as we'll see a little bit later, Baldwin has quite a bit of inventory here, but Baldwin also really missed some sales in the low end, and we'll see that when we go down. Overall plant and equipment, these are some of those investments that we've made. This is what determines our depreciation. And you can see in Erie's case quite a bit, right? And so we've got, a lot of teams actually getting bigger. Baldwin's the one team that really hasn't expanded a lot. That could make some sense. We'll take a look at why I say that. Total assets, $94.6 million. Why I do say that, just in general, okay? Small assets can be more efficient, can also lead to a little smaller equity, which is, you like equity, right? You think, boy, that's a wonderful thing, and it is, but that's the shareholders' equity, and you'll stand a better chance of making better returns for those shareholders if that equity's smaller. Okay, and that's what shareholders want. They want a good return on the amount of equity that they have with you. They want efficiency in those things. Okay, Baldwin ended up with all kinds of liabilities, and that's mainly because of that emergency loan. And again, my guess is because they hit a wrong button, which goes to double checking, triple checking, quadruple checking what's going on, making sure every team member kind of goes through it at the end and see if that's what you wanted or whatnot. So, okay. Common stock, so this goes back to some of those sales of common stock, and you can see here, Ferris has sold quite a bit of common stock. Retained earnings, those things that you keep from year to year, it gives us your total equity, right? When you net out the liabilities, of course, gives us our total equity. So Chester's got a big equity, okay? Baldwin doesn't have any equity. They get back. They had that emergency. It's a tough thing about a dividend too, is that you can't get that back. If you have too much inventory, and that leads to an emergency loan, and that's what I most commonly see. You can sell off the inventory, right? Paying out a dividend, you can't get back. So Baldwin's made a tough. They have a tough path ahead. It's certainly not impossible, and there are some advantages that they might be looking at. They're going to be really highly leveraged. That's going to create some issues, but there's some advantages to being a smaller team that if they play it properly, they could come back and perform and be competitive again. The income statements. Remember up above, I looked at Baldwin. I said, gosh, they only had a 17.4 contribution margin and a 19.6 SG&A. So what's that mean in real terms? Well, they had $120 million in sales and about $90 million in variable costs. That's a relationship that comes out of that contribution margin, right? That's the 17.6 percent. So that's about a $21 million in gross profit. SG&A, remember, was bigger than that, so $23 million. So, like I said up above, just glancing at that, I could say, gosh, they 120 minus 99, that's $21 million in gross profit, but they spent $23.2 million. So that's $2.2 million in the hole before you calculate depreciation, which is $7.6 million, others, and then interest down here. This became their earnings before interest and taxes. You do get to write off your interest, and so it created a little smaller tax liability, but also still a pretty large negative net profit. Might have been a little easier to handle if they hadn't also paid out that huge dividend. Here, I want everybody to take a look. Chester, the team that the computer team, is the only team that's using its capacity. Okay. Again, you can use 2 shifts, and Chester's coming close to using both shifts. The rest of you have all kinds of excess capacity. These are some of those hidden costs that sometimes I talk about. Look at the excess capacity that Erie has. They produced 2 million units, and they could produce over 6 million units. Okay. That doesn't mean that you should go out and produce, okay, like Erie. Okay, so should they go out and produce 12.5 million units? They're probably going to end up with a lot of inventory if they do that, unless they can figure out how to sell them in the competitive environment. So what it means is that, man, oh man, we got all kinds of capacity. Look at that. Chester's reduced its capacity compared to every other team, and yet it's producing more. That creates some efficiencies. These are a little bit harder to see, but you'll see that in depreciation somewhat. Okay, you'll see that in maybe if you go to expand your automation, because now you can expand automation on a smaller scale. Okay, and so you can become more productive because you're increasing your automation, but you're doing it on a smaller scale. A lot of the costs associated with having excess capacity are, I don't want to call them hidden costs, but they don't jump off the paper at you. You got to sit down with a real fine pencil and figure it out. I mean, Erie, if truly they were only going to produce 2 million units like they did, okay, they only needed 1 million units of capacity, okay? So they could have dropped off 5.2 million units of capacity. It's not that simple oftentimes because you got your different lines and whatnot, but at least theoretically they could have dropped 5.2 million units of capacity. Doing that would have raised a lot of cash, okay, which they could have invested in some other things, and it would have saved them a lot on depreciation, might have saved them a lot on interest. They certainly wouldn't have had to sell any stock, and so a lot of these costs are, I dare say, invisible, but not as obvious as looking at, oh geez, I got overtime, right? Look at Chester paid all kinds of overtime, okay, and yet still had a pretty good contribution margin. Okay? More importantly, they had a really good SG. In their case, in this time, they had a really good SG&A. Okay? So those things you got to watch. You got to watch the efficiencies and whatnot. One thing, Chester, we looked at their capacity, but actually their depreciation was fairly high. Kind of normal, I guess, maybe in the middle. Why is that? They've lowered capacity. It should lower their depreciation. But looky here, they've been investing in automation, which is going to drive down their costs, especially here in the labor. Okay, and their labor costs might look a little bit high. Okay, if we look at the low end here, it's actually come down, and it is lower, even though they're using 100% of overtime. Okay, well, why is that? Well, because they've added 2.5 units of automation. Okay, so they're effectively really driving down those costs, even though they're using overtime. They're doing that by buying automation, and that's kind of true throughout. It may not be as obvious in some of these other ones because they still are using overtime. And actually here they haven't invested a ton right, in automation, but they have invested here in both their traditional and their low end. Okay, and we don't see a lot of, well, you get down here to Ferris, and Ferris is investing a decent amount. Okay, they have here, especially in the traditional and low end, invested some money there. They haven't done anything with their capacity. Okay, traditional stats, take a look at it. I'll kind of roll through these. I always like to look at these and just kind of get a rough idea. It's, yeah, you know, Erie had more potential, Ferris had more potential, Baldwin, Chester took advantage of it. You know, Digby kind of took advantage of it. Andrews gave up a little bit. Not huge, although here Erie, you know, gave up about 4%. Okay, which is significant in the traditional. The traditional, there's a ton of products in there, and we'll take a look at why. Probably when we look at the bigger perceptual map. These are good to look at and say, why did this happen or why did that happen? You know, why was Days the #1 seller? Okay, and Baker sold quite a bit. Okay, well, Baker actually has better performance and size coordinates, and that's kind of a big deal, but it's third on the list. Ideal age, let's look at that. Yeah, 2 is the ideal age, and theirs at the end of the year was 2.09. So that means during a lot of the year they were pretty close. And even though Days had a much higher price, also had a better MTBF, which isn't all that important here. Okay, but it's got a little bit of importance, so that helped a little bit. But age was a big factor, and they were the best. But look at also what they spent. Man, oh man, spent a ton of money. Okay, although, you know, that money didn't necessarily buy them a lot more customer awareness or customer accessibility. And going into December, Baker's actually looking not too bad. And some of that might be the performance and size, the coordinates or the positioning of the product. So, again, take a look at those. Try to be, this customer buying criteria is going to be really, really important. I'll tell you again here, too, on this positioning, which for the traditional one isn't terribly important. When you get to the higher ends, it's really important. You have to remember that if you look at the ideal position for next round, if that's what you move it to, okay, you're going to be behind the 8 ball the whole year, because you're just going to meet that, and the demand keeps changing, right? So in order to be in the best position, you actually have to move it out ahead of that. Again, especially in the high performance and size categories, not so much here in the traditional, because it moves a little slower. Is the reason I'd say that. But you'd want to be out ahead a little bit. Okay. That said, I'm going to caution you. Okay. Here's a huge caution. Listen up, please. Don't move too far, or if your revision date gets out there past 1 year, it won't move. It won't move the next year. It'll wait that full year, and you won't be able to make any changes. That's one of the biggest mistakes that little tactical mistakes that teams make. They move too far. They move that revision date. They move their product too far, and it changes the revision date out too far. So that's one of those other things you need to double, triple check at the end and make sure that your revision dates aren't past the next year. Okay, if the next year is 2020, you got to make sure that your revision date is not to have anything to do with 2021. Even if it's January 1, that's too far out. Low end. Here's where, you know, Baldwin, oh my goodness, okay, and this will be one of your questions, gave up just roughly here about 15% of the market, so they had a potential for 15%. Reason for that's price. Okay, Baldwin lowered their price, okay, below everybody else, which is the #1 factor up here. Okay, age is a big factor, and they weren't too far off, although Cedar's a lot closer to the ideal age, so the computer team, they spent a lot on marketing though. And we're in good position here to sell a lot, again, mainly because of price, but didn't make enough. Okay, so this is a case where they just simply didn't produce enough, and so they gave up a lot of stuff, and I'll have you guys calculate that for me. In the high end, this is kind of interesting. You really only got 2 teams, 2 products that are out here competing, Chester and Andrews gave up quite a bit there, about 10%, a little more than 10%. The rest of the teams are kind of letting their products slide, and that can be somewhat normal if you're seeing them maybe create some new products that are out here. I don't see any coming up, and so a little bit surprised by that they've almost vacated. That's why we had such a big crowd in the traditional segment, because really we've only got two products here that are kind of competing. This gets tough. For a product here now, to try to catch up would be almost impossible. You could move it that far, but again, your revision date's going to be too far out, and you'll really take it in the shorts if you do that. And so you can only move so much each year. To try to catch up would be almost impossible. So a little hint, if you wanted to come back and compete in this high end, you about have to introduce a new product. And you'd want to introduce it just outside this line so that it would get just inside the line as it started to sell. And I'm going to scroll through some of these things. You guys should pay a lot of attention. Bids still sold a lot here, didn't sell out. And Andrews, let's see, Andrews gave up a lot of potential, and Baldwin picked that up just because they happen to have some. Because Baldwin's still, their product bids way back here, but still managed to sell some. And there could be some scraps left there. We had a similar thing in the performance category, though there's more teams that are a little bit there. But you can see that the computer team is just right out here on the cutting edge. That's where you got to be. Okay, you got to end up there. That's going to be a low age on it, right? And they have that. They got the best performance coordinates. Size coordinates are pretty good. Okay, but this is the performance segment, so you want to be out here, and Chester obviously is not a lot of competition in that regard. So, and the size, we're probably going to see a similar thing. More other teams are still competing in here, but obviously Chester's way out in front in terms of positioning. And that's one of the things you'll learn, that if you're going to compete in those high ends, high performance size, you got to start early. You got to stay on it. Okay. You guys that are close here definitely still have an opportunity to push and be competitive. It's going to be tough to catch up to Chester, but there's some opportunities to get close and maybe take some market there. So actual versus potential. I asked one question on your homework assignment that has to do with this, and so I'll probably talk about that a little bit more there. It's the perceptual map in a little bigger sense, and again, look at that. I mean, the traditional segment's full. One of the reasons for that is Team Erie introduced 3 new products, okay? And I picked on Ferris and Baldwin. Now it's my turn to pick on Team Erie. They introduced 3 new products, and they introduced them basically in the traditional and low ends. Don't do that, okay? Now you might want to read through your guide. Typically speaking, if you're going to go through the trouble to introduce a new product, you want it up here in the performance size and high-end categories. Okay, it doesn't pay a lot to spend a lot of money on the research and development and those types of things and building capacity and whatnot to introduce a product down here. You're better off if you're doing like a low-cost product life cycle. You're better off introducing a new product up here and let your existing product slide back, which is happening. Okay, and Team Erie, is in that position. They got a product here called Ear and one called Echo, and I don't remember. Echo, I think, was their high-end product. Well, sliding back, they introduced Ear here, so they got 2 products pretty close. They'd been a lot more competitive, obviously, if they would have introduced their E product kind of up here. There's some more stuff there on performance. I don't spend too much time on that. HR I kind of like to take a look at. You guys had an opportunity to invest some money in HR. It looks like the only team that did enough really was Team Digby. And you see that improved their productivity by 2.2%. Doesn't sound like a lot, but keep in mind that that's kind of a number that's right off of your labor. Okay, and your labor cost right now is probably, based on what you guys are producing, $30 or $40 million. So 2%, you're getting close to 2.2% to saving $1 million. Now, that savings will be for the rest of the game. And I've seen this number, this productivity index, get pretty high in some games. If you can, and keep in mind too that your labor cost is going to grow, right? This is a fast-growing industry, so you're going to continue to grow tremendously over the next several rounds. And so what happens if your labor cost gets up to $90 million and your productivity is 10%? Ooh, all of a sudden you're saving $9 million per year. That's can be a significant competitive advantage. So something to kind of keep in mind there. One of those investments that you can certainly make that can improve. It's going to have some long-term consequences. It's going to cost you a little bit in the short term. I do believe that these are expenses. It's not like automation. Automation is not an expense. Automation is just a transfer of assets from cash to physical facility. Okay, there's no expense involved in that other than a little bit of depreciation that you're going to get. Okay, so that doesn't really show up on the year-to-year when you make those kinds of investments. These do, the similarity that they have is that they both have good, positive, long-term payouts, and so determining what those payouts are and whatnot, the other side of this that's an advantage is, well, this is an expense, it's deductible, okay, so it positively affects your taxes, so takes a sharp pencil to sit and figure all that out. Probably we won't get into that much detail and calculations and whatnot in this class, but that's what financial managers do, is they do sit down and pencil those things out, and I find it kind of interesting. So there we are. There's kind of the recap for the round. I'm going to stop there. I'll send out a little deal on the spreadsheet, this week's assignment and last week's assignment. So thanks. Good luck in round 3.